Section 1. Investing Made Easy. Say hello to mutual funds. These investment vehicles are designed to make your financial journey smoother and more accessible. So, you want to make your money grow, right? Who doesn't? But where do you start? The stock market can seem like a jungle. Too many choices, too much risk, and it can be overwhelming for beginners and even seasoned investors. That's where mutual funds come in. They make investing easy peasy. You don't need to be a financial expert to get started. Imagine this. You want to buy a bunch of different fruits, but you don't have a cart. It would be a hassle to carry them all individually. A mutual fund is like that handy cart, holding a mix of stocks or bonds. It simplifies the process by bundling various investments together. You get a little bit of everything, all in one go. Pretty neat, huh? This diversification helps spread out risk and can lead to more stable returns. Mutual funds are like a team effort for your money. A group of experts works together to manage the fund, making informed decisions on your behalf. A smart fund manager picks the best stocks or bonds, and you get to share in the profits. They do the heavy lifting, so you don't have to. It's like having a personal chef for your investment portfolio, without the hefty price tag. You get professional management at a fraction of the cost. Ready to explore the world of mutual funds? They offer a gateway to global investment opportunities, allowing you to diversify beyond local markets. Let's dive in.
Section 2. Think of a mutual fund as a basket of goodies. Remember those gift baskets you get during the holidays? They're packed with yummy treats, all in one package. That's kind of how mutual funds work. Let's say you want to invest in the stock market, but you're not sure which companies to choose. A mutual fund lets you own tiny pieces of many different companies. It's like having a slice of the entire stock market pie. Think of it this way. You love pizza, right? But instead of ordering a whole pizza from just one place, you get a few slices from different pizzerias. You get to try different toppings and flavors, all in one meal. That's diversification, and it's a key benefit of mutual funds. More on that later. Section 3. Different flavors for different tastes. Types of mutual funds. Just like there are different types of pizzas, there are different types of mutual funds. Each type of mutual fund is designed to cater to different investment preferences and financial goals, much like how different pizzas cater to various taste buds. Each one has its own flavor and ingredients catering to different tastes and investment goals. Whether you're looking for high growth, steady income, or a balanced approach, there's a mutual fund out there for you. Some folks like their investments spicy, aiming for big growth. They might go for equity funds, which mainly invest in company stocks. These funds are designed for those who are willing to take on more risk in exchange for the potential of higher returns. These funds are like the pepperoni pizza of the investing world, a bit riskier, but with the potential for sizzling returns. Equity funds can be volatile, but they offer the chance to significantly grow your investment over time. Others prefer a milder flavor, seeking a stable income stream. They might choose bond funds, which invest in bonds issued by governments or companies. Bond funds are generally considered safer than equity funds, providing a steady income with lower risk. Bond funds are like the classic cheese pizza, reliable, consistent, and less likely to give you heartburn. They offer a dependable source of income, making them a popular choice for conservative investors. And then there are those who like a little bit of everything. Balanced funds combine stocks and bonds, offering a taste of both worlds. These funds aim to provide both growth and income, making them suitable for investors who want a diversified portfolio. They're like the supreme pizza of mutual funds, a balanced blend of growth and stability. Balanced funds are ideal for those who want to enjoy the benefits of both equity and bond investments without having to choose one over the other. No matter what your investment goals are, understanding the different types of mutual funds can help you make informed decisions. By choosing the right type of fund, you can align your investments with your financial objectives and risk tolerance. So, whether you prefer the spicy kick of equity funds, the mild stability of bond funds, or the balanced approach of mixed funds, there's a mutual fund out there to suit your taste. Happy investing! Section 4. The Stock Market Safari Exploring Equity Funds. Let's venture into the exciting world of equity funds, where the potential for growth is as vast as the African savanna. Equity funds are like those off-road vehicles that take you on a thrilling ride through the stock market. These funds come in different shapes and sizes. Some focus on large, well-established companies, like majestic elephants roaming the savanna. Others target smaller, faster-growing companies like nimble gazelles darting through the grasslands. There are also equity funds that specialize in specific sectors, like technology, healthcare, or energy. It's like choosing your own safari adventure, focusing on the animals that interest you the most. Equity funds are generally considered riskier than bond funds, but they also offer the potential for higher returns. It's a classic case of high risk, high reward. Just remember to buckle up and enjoy the ride. Section 5. Steady Eddie, the world of bond funds. Now let's hop aboard a comfortable cruise ship and explore the calmer waters of bond funds. These funds are like the reliable, steady-going vessels that offer a smoother ride for your investments. Bond funds invest in bonds, which are essentially IOUs issued by governments or companies. When you buy a bond, you're lending money to the issuer, and they promise to pay you back with interest. Bond funds are generally considered less risky than equity funds, but they also offer lower potential returns. It's like choosing a relaxing cruise over an adventurous safari. You might not see as much excitement, but you're less likely to encounter any unexpected bumps along the way. Section 6. Myth-busting, don't believe the rumors. There are a lot of misconceptions about mutual funds floating around. Let's clear the air and debunk some of the most common myths. These myths can often deter potential investors from making informed decisions, so it's crucial to set the record straight. Myth number 1, mutual funds are only for rich people. Nope, not true. This is one of the most pervasive myths out there. You don't need to be a millionaire to invest in mutual funds. In fact, mutual funds are designed to be accessible to a wide range of investors. Many funds have low minimum investment requirements, making them accessible to even beginner investors. This means you can start investing with just a small amount of money and gradually build your portfolio. Myth number 2, mutual funds are too risky. Well, that depends. Risk is a relative term and varies from one fund to another. Like we discussed earlier, different types of funds carry different levels of risk. Some funds are designed to be more conservative, while others aim for higher returns with higher risk. Bond funds, for example, are generally considered less risky than equity funds. They offer a more stable investment option for those who are risk-averse. Myth number 3, you need to be an expert to invest in mutual funds. Not at all. This myth can be particularly discouraging for new investors. Remember, mutual funds are designed to make investing easy. They are managed by professional fund managers who make the investment decisions for you. You don't need to be a financial whiz to get started. The process is straightforward, and there are plenty of tools and resources to guide you. There are plenty of resources available to help you choose the right funds for your needs. From online tools to financial advisors, you have a wealth of information at your fingertips to make informed decisions. Section 7. Ready to dive in? Getting started with mutual funds. Feeling excited about mutual funds? Great! Here are a few simple steps to get you started. First, determine your investment goals. What are you saving for? Retirement? A down payment on a house? Knowing your goals will help you choose the right types of funds. Next, choose a brokerage account. You can buy mutual funds through online brokers, traditional brokers, or even directly from some fund companies. Then, research and select funds. Look for funds with a good track record, low fees, and a management team that aligns with your investment philosophy. Once you've chosen your funds, you can purchase shares through your brokerage account. Remember, investing is a marathon, not a sprint. Start small, stay consistent, and don't be afraid to ask for help along the way. Section 8. Don't put all your eggs in one basket. Diversification is key. One of the golden rules of investing is diversification. Don't put all your eggs in one basket. Why? Because if that basket falls, you lose everything. Mutual funds make diversification easy. Remember that analogy about the pizza slices? By investing in a variety of different stocks or bonds, you spread your risk and increase your chances of earning consistent returns. Think of it like building a house. You wouldn't build a house on just one pillar, right? You'd use multiple pillars to provide a strong and stable foundation. Diversification is like adding extra pillars to your investment portfolio. Section 9. The power of time. Let your money grow slowly. Investing is a long game. The sooner you start, the more time your money has to grow. It's like planting a tree. The best time to plant a tree was 20 years ago. The second best time is today. The magic of compound interest is on your side. When you reinvest your earnings, your money starts to grow exponentially over time. It's like a snowball rolling downhill, getting bigger and bigger as it goes. So even if you can only invest a small amount each month, don't underestimate the power of time and consistency. Start small, stay invested, and watch your money flourish over the long haul. Section 10. You've got this. Embracing the world of investing. Congratulations! You've just completed a crash course on mutual funds. You've learned what they are, how they work, and why they're a great option for beginner investors. Now, it's time to take action and put your knowledge into practice. Remember, investing doesn't have to be intimidating or complicated. Mutual funds provide a simple and accessible way to grow your wealth over time. So, what are you waiting for? Start exploring the world of mutual funds today. Your future self will thank you for it.